Well, within emerging markets, we think there's so many countries to pick from. We have 24 of them overall. It really is a good diversifier if you're investing in the global equities environment. If you want exposure to non-US investments, there are a lot to choose from within emerging markets. Our process is designed from a top-down first, right? So we decide on what we will own within the 24 markets that are in emerging markets. Emerging markets go right or wrong at the country level. So we need to decide on what factors to look at that drives that country. And more importantly, we need to look at valuation and expectations. That really drives our decisions. So we think that it's very important to look at risk-adjusted portfolio. When we think about our positions, we would look at the country we want to invest in, then we think about the stocks that we want to put into the portfolio. When you put it all together into the overall portfolio, we want to make sure that we look at the risk we're taking. We're not taking any unintentional risk, because that's really, really important. When we are perhaps making a decision where we know that we're taking some risk, but we just need to know at what point will we actually change our allocation, because some of the risk could be binary, and we want to make sure that at a risk-adjusted basis, we're taking the appropriate level of risk. Well, first of all, we all want to make money for our investors. Our performance is important, and we'll stick with what we do best, and that is we look at the top down and we decide on which country we like, and then we make an allocation to the right thematic within that country, and then building up our positions that way. We find that we need to find the right stocks and themes to express what we see from a top-down perspective. We're very excited about China at the moment. We think that the stimulus on the economy would be very positive for Chinese consumer. Even before the stimulus, we've always had a theme that is focused on the domestic China opportunity. If you think about Chinese consumer, it has actually changed completely. If you go back 25, 30 years, people my generation or a little older, anything foreign would be preferred. If you have a name that sounded foreign, you can get a price premium. Now that has completely changed. Looking at younger generation of consumers, they embrace Chinese brands. As long as you have efficacy, they will embrace the product. So I think that's a major shift when it comes to Chinese consumption. The other thing is, within China, we need to align our investments with what Beijing government wants. Beijing government doesn't want the consumer to be spending on your LVMH, your Nike of the like. They want you to spend domestically. Domestic brands, domestic travel. China is a big country, and they have built infrastructure in the past 10 years that we are now reaping the benefits. People can now hop on the train and go visit other provinces, and that's how they travel. Domestically, there are a lot to spend on. So within our portfolio, we're very focused on the domestic consumption opportunities. Whether it is on travel, we own a couple of companies, Trip.com, that is like the Expedia of China. We also own another company called Tongcheng, which is very similar to Trip, but it goes down to the lower tier cities because Trip doesn't have that capability to go further down the system. So we're very excited about the opportunity within domestic China, regardless of what tariffs will be, what foreign politics will be. We think China wants to control the destination, and we are going to stay on this consumption trend, I think, for some time.